I want to bring in right now Andrew Schiff of Euro Pacific Capital to talk about exactly what's been happening with gold. He is the co-author of How an Economy Grows and Why It Crashes. One thing that's not crashing right now, Andrew, and that is gold. There's the book cover, but gold, to tell you what, up 80% from October of 2008. $50 in the last week or so for gold. I mean, but can this continue?
Well, yeah, I mean, this is a big week because basically Ben Bernanke and the Fed said on Tuesday, hey, everybody, go out and buy gold, buy lots of it. I mean, they basically, for the first time, came out and explicitly said in their Fed statement that they are targeting a level of inflation as part of their mandate. They think inflation is too low. They've got to bring it up. They've got to print more dollars to do that, and they've got to expand the amount of currency in circulation. Other countries, even England, Japan is trying to keep their currency weak versus the falling dollar. China's still maintaining its tenuous peg. So everybody's printing money. And that's a great reason to buy gold because everything that's not a currency will increase in value. And if you look at gold, which has historically been money for thousands of years, and you look at its chart over 10 years, it's a slow, steady build, and it's always being catalyzed by these currency movements. So we think it's going up from here. We think certainly that the 1980 inflation-adjusted high for gold, which would be around $2,200 an ounce, is certainly a midterm target for the price of gold. So it's going to continue to be buoyed up. It could go down. It's not going to go up in a straight line. If you want to buy the dips, buy the dips. But gold should be the set it and forget it portion of your portfolio until at least you get a meaningful change from central bankers around the world and the Fed in particular, that this era of liquidity and an expansion in monetary stimulus is coming to an end. And there's no view of that in sight.
All right, you know what, James? I mean, here's the thing. I mean, obviously a safety play, and Andrew's making a good point. Maybe you could buy on the dips on gold. But at the same time, that means that maybe you're bearish on equities, yet we're seeing a run-up in the equity markets for the month of September. Does it have to be an either-or scenario?
Well, I thought that the two would have to go hand in hand, as you just mentioned, and that's actually a question I would put to you, Andrew, is that certainly gold's rise does reflect that there's an awful lot of money being printed, and that would fuel the flames of inflation. But A, we're not seeing any signs of inflation really at all. B, the rest of the commodity complex really hasn't participated in any sort of inflation rally. So oil's kind of stuck. You know, steel, some of the more industrial metals are even down over the short term. And you certainly haven't seen interest rates showing any fear of strong inflation. How do you square that circle with gold clearly screaming out we got inflation and the rest of the indicators not doing so?
Okay. Well, first of all, have you checked the agricultural commodities recently? It's not just gold that's heading up. There's a lot of other things. Maybe some metals aren't keeping pace with gold, but there's plenty of commodity prices that are going up. You don't have to look very far to find them. But the reason why you might not be seeing prices going out of control right now is because we're stuck in the middle of a major recession. Whether it's a double dip is coming, it's all part of a larger recession that was interrupted by some artificial stimuli. But in a recession, prices should be falling. I mean, we had a huge asset price increase during the last decade, which came to an end. Prices should be falling. They're not. The reason why prices aren't falling is because there's a lot of inflation. And I define inflation as an expansion in the monetary supply. So the fact that prices are stable.
But let me get to that. Hold on. I want to bring in Lori Rothman into this because, Lori, in particular, what we have seen as well is a weak dollar. Certainly there is the safety situation with gold, but at the same time, the weak dollar also makes it more attractive, just like oil.
Absolutely. And there's a huge camp, and it's growing in loudness and thunder, right, that gold is a bubble. So what aspects do you look at? What would be the catalyst to burst that bubble? Andrew, have you thought about that?
Well, I don't think gold is a bubble. I mean, first of all, earlier in the show, Phil said stocks are looking good because of artificial stimulus and a cheap dollar. I mean, those are temporary, kind of illogical reasons to be happy about stocks. If anything, that would be stock prices would be in a bubble. I mean, gold is something that people want, that people cling to traditionally. There's a limited supply of it. It's hard to find. It's by nature scarce. It's not like something you can print off the presses and flood the world with. So I don't, if you look at the long-term chart about gold, you don't see any bubble characteristics there. Not like 1980 where maybe that was the case.
But hold on, but Phil Flynn, what we have seen, maybe not a bubble characteristic, but you have seen a major run-up in gold, in particular in the last year. Certainly a lot of that is fear-based. And Andrew says, look, buy it on the dips, it's still a solid play. But at the same time, it does seem to me that we have seen a little bit of a bubble in the last 12 months on gold.
Well, I think Andrew is right from the long-term perspective. I mean, this is a market that looks like it has a technical destiny. If you look at the long-term charts on gold, I agree with him. It looks like we're heading to 2,300 an ounce very easily. And why is that? Because commodity prices have a tendency to cycle from all-time lows to all-time highs. We were down at all-time lows in 1999. Now we're going to test all-time highs. Does that mean it's a bubble? No, it's the way that markets work. And there are other reasons to buy gold than the weak dollar. People are buying gold because of fear. They're not just the dollar. That's part of it. They're afraid. People are nervous out there. They hear the Fed printing money. They hear, they hear banks failing. This is not the America they know, and that's why they're buying gold.
Nicole,
now, how long that's going to last, we don't know.
I see you trying to hop in, Nicole.
Listen, without a doubt, and it really is a fear-based play. We can talk about inflation, we can talk about the dollar, but really it is the one thing that is a tangible item. I know of a young woman who has cash on hand, she's single, and what she has been doing with her cash is buying gold a little bit at a time and putting them in the drawer, because if the Eurozone collapses because of sovereign debt, because we worry about our economy, we don't just turn on a dime. The one thing you can always go to as a tangible thing that's worth a lot is gold.
Why can't you call treasury prices a fear-based play? Everyone's buying treasuries because of fear.
It is.
And but treasuries can be inflated at the push of a button. The treasuries have no intrinsic value. Gold, you can't go out and find it. I mean, it's finite. It's hard to find. You can't inflate it at will.
But Andrew, treasuries pay you interest where gold does not.
They do?
That's the difference.
They do? Oh, a whopping
they do. Well, it depends. If inflation goes the other way, it won't. But I know what you're saying. At some point, get the tips. There you go. You'll do better on the tips. Get the tips.
You too. But let me bring in Lori, because again, Lori, if you go back to if you look at long-term returns, if anybody's investing 5 years, 10 years, traditionally it is the equity market that we turn to, not gold, not Nicole's young friend who's putting gold in the drawer.
Although it is kind of enviable to be that young friend, right? To have all that extra cash to be buying gold right now. But it's the uncertainty, and I'm curious with the Republican rollout today if we're going to clear up any of that uncertainty. And maybe, I mentioned the bubble issue earlier in this discussion, if some of that will clear it up, and once we get a little bit of confidence where things are going, I think people are looking at the stock market to grind higher right through the end of the year. We've got the midterm election coming up, so all of these answers, hopefully with a ton of economic data next week. Let's get some answers.
Sure, James?
Well, I have one more question for Andrew, since we have the expert here. I got to ask this. The professors of the world would say that gold's rise is an indication of the debasement of fiat currency. It's at least one interpretation of it. But
that's a pretty solid interpretation.
Right. So my question to you is this. The upside rise in gold over the short term has certainly exceeded any rise in any major currency cross that you would look at, whether it's, dollar euro, whether it's dollar renminbi. It's now debasing, it seems, every currency. And thus it's sort of a beggar thy neighbor, and it sort of leaves gold up here, and you can still trade in fiat currency.
I disagree with the premise. I mean, if you look at a lot of currencies, let's suppose the Australian dollar has gone up probably 30% in less than 12 months. I don't have the figures exact, but it's about in that range. I mean, gold hasn't seen that kind of rise. And also, if you look at other stock market movements, if you look at the Dow in the late 90s, I mean, it went up 50, 60% in a couple of years.
But Andrew, here's the thing. But commodities, even a gold. I mean, I know that again, you're talking about gold and treasuries and safer places to put your money for the moment. I go back, Andrew, to the mid-90s when we saw. Look at what happened to silver. I mean, I know that you're referencing other commodities. Talk about silver. Talk about copper.
Silver is more volatile than gold, and it has been historically. It's got more of an industrial exposure to it, so it tends to ride with the markets a little bit more closely than gold. But gold, silver lost 2/3 of its value, or 60% of its value back in 2008. It's hitting up close to an all-time high right now. I mean, or a 3-year high right now. So yeah, there is volatility there, less so in gold because it's more monetary. But if you look at the long-term trends, if you throw up an inflation-adjusted chart for gold or silver, you can see these mega trends. They're very clear. You look back in 1980, there was a spike in gold. We're still far below that in inflation adjustment terms. And if you recognize the reasons that gold had a spike back in 1980, which was all a monetary phenomenon, and you see that those same stimuli are available now, in fact, greater than they were before, you can see that these prices shouldn't be scaring anybody.